He is a research associate of the National Bureau of Economic Research, a member of the Council on Foreign Relations, and a member of the Economic Club of New York. He received his AB in economics from Harvard University and a PhD in economics from Massachusetts Institute of Technology. So I will welcome him to the stage to start a conversation.
Thank you. Thanks.
So there's about a dozen different topics that we can dive into, and I'm sure over the course of this conversation, we'll get into many of them. Just a reminder to folks in the audience, if you download the NABE Connect app, you can ask questions through there. But before we dive into specific topics, I figured I would just ask you for your current read on the state of the US economy. How are things looking here at the beginning of 2026? What has surprised you? What has gone the ways you've expected? What are the pleasant stories? And what are things you're maybe a little bit more concerned about?
Great. Thanks so much for having me. It's a pleasure to be here at this venue. So I think overall, the economy has overperformed estimates, and we can look at different pieces of it. I think the most exciting piece of the economy involves GDP growth, productivity, and wage growth. And I'll just look into that a little bit. GDP growth was extremely strong in Q2, Q3, Q4. It fell by, our estimates are around 200 basis points because of the shutdown, but it would have been around 3%. So with growth like that over even the growth despite the shutdown is above where forecasters were last fall, right before and also right after the election. So overall, GDP is overperformed. That's coming together. And then if you look at what are the sources of that growth, the sources of that growth are productivity and investment. This productivity growth has been extremely strong. So it's really a supply side growth. And then we have reasons to think that why all that is happening, and we can get into that later. And then the other part of that is that productivity growth is trickling down into wage growth. So if you look at weekly wages, wage growth, it's been outpacing inflation by 1% for the year. If you look at specific categories like manufacturing, and if you dig deeper, you look at like manufacturing non-supervisory employees there. Nominal wage growth is 5.4%, and you compare that to your favorite inflation rate. That's quite significant. So on the supply side, on the GDP, productivity, wage growth side, it's an incredible story. If you look at other pieces of the economy, on the labor market naturally, because of the fact that there's been a halt to illegal immigration as well as deportation efforts, is not going to provide the types of large numbers that we saw under the Biden administration. But despite that, the numbers are coming in either around many estimates of break even or slightly higher than break even. If you look at the unemployment rate, it's low, stable. If you look at the labor force participation rate for prime age workers, it's the highest level since 2001. So on the labor market side, it seems we talked over lunch about whether the supply and demand factors when you think about deportation. It looks like those two factors, it looks imbalanced to me. And then finally, if you consider inflation and what's happened there, we've had significant growth, stable unemployment rate with decreasing inflation, with significant disinflation. There was a bump up in goods inflation over the year. I think a lot of that has to do with supply chain realignment, because we see that kind of inflation manifesting itself in other countries too. It's not unique to the United States. But if you look at other parts of it, like on the services side and on rents and imputed rents and actual rents, you see significant disinflation there, which should probably continue into the future because it's all very backward looking. So overall, it looks like a very healthy economy, and that's being borne out in the financial markets.
So I want to pick up a thread you mentioned there in terms of the bump up in goods inflation that we've seen recently. And you'd mentioned that it's a trend that we're seeing other economies. So could you talk us through that a little bit more? Because that's something that has been, I think, top of mind for many people, is from the amount of inflation, how much of this can we attribute to changes in U.S. trade policy? So curious about your interpretation of that.
I think, so if you look at core goods, compare core goods inflation in the United States to the UK, to Canada, Mexico, you'll find that core goods inflation is actually lower there. And that's, that suggests, although it's elevated relative to historical, but it's elevated in all these other countries as well. Europe is the one exception where you don't see a pickup in core goods that like this. But that seems consistent with a situation where there's a lot of reshoring and friendshoring along the globe, causing significantly more demand globally for goods, and that would put upward pressure on certain items, right? One way there's two things to look at there. If you look at the latest trade numbers, for example, the latest trade numbers, I think about a third of all of the imports were basically capital goods. So that tells you that there's a significant effort underway to invest domestically and reshoring. That's happening globally. So that's putting a lot of pressure on capital goods prices. And the other thing is, if you look at the deflator portion of investment, that's been a little bit elevated. That suggests that there's a lot of demand for investment goods there. So that gives you an idea of where some of that inflationary pressure may be going. But again, I would view this more as a level shifter than a longer term trend.
So it's almost the investments good correlate with some of the pickup in goods inflation you saw.
There's more demand for real goods. I mean, it's just happening globally because of the restructuring of global supply chains, which is, in part driven by it's driven by all these negotiations of trade deals and so on. But that's one way to explain what we see there.
So to turn to those trade deals and the changes in tariff policy, I'm just curious. Obviously, last Friday, the Supreme Court's ruling sort of upended the current play of tariffs, and there's been some changes there. But prior to that, we had an extended period with these more elevated tariff rates and these renegotiations or negotiations of deals. So I'm curious, in your view, in the administration's view, where do we see the evidence of these shifts in the economic data? What are the sort of
evidence of
sort of where we see the impact of those policy shifts? What are the what's the fingerprints? Where do we see those in the U.S. and global economy?
The impact of the trade deals?
Yes, and the change in tariff rates.
The way I would think about the impact is in terms of which sectors in the United States are growing the fastest in terms of value added, which ones are experiencing the greatest productivity gains, and the fact that you've got all of this importation of investment goods that's happening even more recently. It's throughout. It's not front running the tariffs, which is sort of what we saw in Q1. So that tells you that obviously there's lots of anecdotal evidence, and I speak with business leaders all the time who are telling us that they're either friendshoring or reshoring domestically, and so I think that's been a big result of this. The other thing you can look at are very specific targeted places of coordination, like coordinating on the critical minerals supply chain, which is also an outcome of all of these negotiations with trading partners, and that's ensuring that our supply chain is and for the longer term is strengthened and is not overly reliant on a geopolitical adversary.
So one of the dominant themes of this conference, unsurprisingly, has been AI, its current economic ramifications, and what it might hold for the future. So could you just give us an overview of how the administration is thinking about this, its current sort of implications, its impacts right now, and what the future might hold?
Great. So, I mean, in general, I don't think government officials, the government should limit innovation. The government should facilitate innovation and ensure that we have current and future human flourishing. And the approach of the administration, as is evidenced by the president's executive order on AI, is that we're taking a risk-based approach, and which is different than the previous administrations, and is also different than the approach that's being taken in Europe, where there's a lot of emphasis on safety. So overall, the administration's position on AI is to lean into it, taking into account that private businesses are the ones that are best at judging the best use cases for this for technology, but also ensuring that the government can provide more support, better infrastructure, better deregulation wherever it is needed in order to ensure that we don't have any unnecessary impediments that prevent this type of innovation, and also ensuring that the government is the government is ensuring that we dominate in AI internationally, so that American AI ends up being the norm broadly. And in fact, when you look across the world, that's borne out in the data. That the most rapid adoption of AI globally, enterprise AI, is basically American AI. Also, the other thing to note is that while the adoption in 2024 was really mostly large companies, the adoption of AI at the enterprise level has shifted in this year towards smaller companies. That's telling you that more of the productivity gains that could be had from AI are going to dissipate more broadly throughout the economy. In terms of the AI's impact on jobs, it's natural to think that just like any other technological innovation, that comes with some volatility and some disruption. On this point, I like to be humble, and I just like to read what the research says on this versus think about apocalyptic science fiction scenarios. So the research suggests that a lot of the tasks or the jobs that AI can facilitate they tend to be had by young, dynamic, agile individuals. So that's a note of optimism in the sense that we can imagine rapid adoption or shifting without too much disruption. The other thing to note, there was an NBER paper that came out last Monday suggesting that that AI actually reduces the gap between high-skilled and low-skilled workers on certain tasks, which is also encouraging. That suggests that in contrast to some of the other innovations of the early 2000s, which were automation, that this is actually might even be low-skill bias versus high-skill bias technical change. So this is just some of the early evidence that we see on this, and we'll see where it pans out. In terms of what the administration can do, we can ensure that the economy continues to boom, because in a booming economy, the type of adjustments and disruptions that AI will require will be more seamless. They're less likely to cause huge disruptions. You're more likely to see companies, adjust their business models and workers reallocate towards, the best jobs in a booming economy. So I think that's what we can do to ensure that this technological innovation seeps through the economy and with as minimal volatility as possible.
Gotcha. So to return to your introductory remarks about the pace of economic growth last year, there's one line of thinking that a lot of the growth that we saw in 2025 was, if not solely, heavily driven by the build out in data structure. So that therefore AI was a big reason why you had the relative strength in GDP growth. So curious on your thoughts of what portion of 2025's resilience can we sort of attribute to that particular investment?
I mean, I think when you look at the markets versus when you look at GDP, they're looking at different things. It's true that the markets have been very excited about AI, but if you look at GDP and where GDP is coming from, and you look at consumption, overall consumption has been resilient. If you look at value added, you look at the production of goods. The production of goods, not just capital goods, has been very strong. And so given that you have sort of broad-based productivity gains, broad-based growth in value add across sectors, and then the dispersion in job growth, albeit at a lower level because we don't have illegal immigration, the dispersion in job growth is low by historic levels. So Jason Furman actually recently wrote about this. And same is true as the dispersion in nominal wage growth. So that tells you that prosperity is pretty broad-based when you look at the sources of economic growth.
And that last point was something I was going to ask, so maybe we can dive into a little bit more, is that another narrative is that, yes, there was resilient consumer spending, but a lot of this is K-shaped in nature, that it's driven heavily by the top. So curious if you had any other thoughts sort of like along that.
There's a lot of research on this. There's some recent studies that came out questioning this K-shaped narrative. As I mentioned, if I just look at wages, our own research that's public or data publicly available shows that the wage growth is broad-based. And so if the wage growth is broad-based, that tells you that prosperity is broad-based. If we look specifically at the consumption piece, which is what the K-shaped narrative is about, the New York Fed recently put out a study questioning the K-shaped narrative, looking at proprietary data, basically saying there's no evidence of it. Barclays recently put out something using the consumer expenditure survey and then extrapolating from the consumer expenditure survey, basically saying that consumer consumption shares by different percentiles of the distribution are pretty stable. So I would say that I don't think there's strong evidence in favor of this kind of K-shape.
Gotcha. So just turning to a couple of questions that we've received in the app. And again, this is a plug. If you have any questions, to please ask them. Just one question getting at, we discussed earlier, goods inflation and tariffs. So one question is asking, what's the sort of the incidence of the tariffs? Who's actually like paying for those?
Right, the incidence of the tariffs. So this has been a big story about some research papers on the incidence of tariffs. I think I'll just talk about the work that's been done on this and our thoughts on that, and then more generally, like how to think about the tariffs. The work that's been done on tariff incidence is the second most famous regression in international trade. The most famous regression in international trade is the gravity equation. The second most famous regression is the pass-through regression. And the one thing that the pass-through regression does is look at the correlation between tariffs and changes in relative prices. Okay, that's all that pass-through regression does. It doesn't tell you a single thing about incidence. And so there's been some intellectual leaps from the impact on relative prices to incidence, which are not actually correct using like Econ 101. Because if you want to state anything about incidence, you have to look at, you don't look at just at relative prices, you look at how quantities change, you look at how wages change, and you look at how wages change relative to the price level. So none of those things are done in those studies. And so naturally, you can't draw any conclusions from those studies. So that's the first thing I'll say. Second thing I'll say is it actually possible to determine incidence? In theory, yes. However, if you have an economy that is being hit by multiple shocks, it's being hit by tariffs, by trade deals and changing the supply chain around, by a reduced immigration shock, by a change in tax policy, and then significant deregulation agenda. I think that if you've got all these 5 shocks that I just mentioned, and you're going to tease out the impact, given what I just said about incidence from one of those shocks, I think that's not going to be possible. So what you could do is you could look at the totality of what all of these different changes in policies are doing, and then after you do that, you look at the entire economy the way that I'm looking at it, and then you say the outcomes look pretty good.
Gotcha. All right. So another question from the audience. Speaking of one of the shocks or changes that you just mentioned is, so how are you thinking about the economic effects of the administration's immigration policy? We touched on this a little bit with shifts in supply and demand labor market, but just curious about the overall evaluation.
Right, great question. So what's remarkable is despite the fact that we have 300,000, based on the census, 300,000 fewer people in the economy relative to trend in 2025, it's remarkable that despite that, you have had this type of economic growth, because I think most economists would have thought that this would be a drag on economic growth. It turns out that that's not the case. And I think there's a lot of reasons for that, that we need to be thinking about. First, a lot of the illegal immigrants are low skilled. And so at the end of the day, this is not creating as much GDP as people may think. Second, these people often come with families, and so if you think about the fiscal impact of illegal immigration, it's a net drag on the economy. This is true. This has been borne out in numerous studies, both in the United States as well as in the European context. So from a fiscal position, you have the end of illegal immigration is actually a fiscal benefit for the economy, and so that's actually that's a good thing. And then the other thing to consider is that illegal immigration puts strain on limited resources. I mean, aside from some of the social pieces of it and the fact that it puts downward pressure on the and at the bottom of the skill distribution, it also puts a lot of pressure on limited resources, on limited public resources, on limited private resources like housing. And so I think you have to look at illegal, low-skilled immigration from that light when you think about the overall impact on the economy. In terms of the data, what it means is that the break-even rate is lower, right? And so you get accustomed to a lower, longer-term break-even rate. It also means that in the near term, part of the productivity gains that we may be seeing are actually a compositional effect, where by getting rid of the lower parts of the skill distribution, you're increasing the overall distribution, the overall productivity of the workforce, because you're cutting off the bottom. The last thing I'll say is that it does seem, there's plenty of research showing that that this type of reduction in low-skilled immigration is not so disruptive. We know this from some of the work that's been done on the last time that this sort of large-scale deportations happened, where there's an American Economic Review paper looking at this, basically showing that there was no noticeable change, in economic activity as a consequence, and a lot of the rationale for that is that businesses could easily replace a lot of the low-skilled workers with other types of organizational improvements. In some sectors in the United States, for example, like in food and drink, where you might think that there's a lot of illegal immigrants, you actually see an uptick in hours there, for example, which suggests that some of this can be done with native-born workers working more hours.
So just to return again to the supply-demand story and sort of weave this into the current state of the labor market. Over the past couple of days, we've had sort of two sides of a debate. It feels like on yesterday we had Governor Waller speaking, and then earlier today we had President Goolsbee speaking. They're sort of taking two different views of the current slowdown in hiring. Governor Waller, more of the view that we're seeing it's more demand driven, and he suggested, yes, you've seen that there has been a supply slowdown, but we've seen nominal wage growth cool at the same time. And President Goolsbee emphasizing more the stability and rate-based measures of slack, like the unemployment rate or some of the data we get from, say, JOLTS. So my hunch is that you're more on the supply side, but I wanted to give you some space to sort of maybe fully tease out.
That I'm more on the supply side in the sense that
you view the slowdown in hiring as more coming from the slowdown in population growth.
Well, I actually think they look to me like they're in balance. Because the hiring rates are like near historic levels. The aberration was the last 4 or 5 years, right? Where you had major changes in whatever measure you want, and the JOLTS just started behaving oddly because you had an extremely inflationary environment, and those sorts of environments, like there's some recent work on this paper in the Quarterly Journal of Economics looking at how that can lead to significant quits and worker reallocation because of sticky wages and things like that. And so we were living in an environment with significant labor market flux during the past few years, in part because of the inflation, in part probably because of the illegal immigration. So I think what it looks like is a return to something that's much more normal. So that's how I view the current state of the labor market. So hiring rates, quit rates, et cetera, historic levels, the unemployment to vacancy ratio back to historic levels. And so I would say they're broadly imbalanced, but you have to always keep moderating it and as we go along.
So a question from the audience. With federal deficits projected to remain elevated even in a full employment economy, what does a credible long-term stabilization path look like?
Is this with respect to the CBO report, probably?
Let's assume so.
So I think the CBO report had a particular forecast for the economy, and I think there's a couple of things we could say about the report. Naturally, the CBO often is more conservative in terms of its outlook. I'd say that it's going by historic levels of GDP growth, but it's ignoring the fact that for the past 3 years or so, we've had around 3% GDP growth. So if we look at probably the best way and the easiest way for our economy to deal with its long-term with the long-term fiscal trajectory is to get additional GDP growth. And that's what the administration is working on, and ensuring that through all of the different policies that I outlined at the beginning, that we get this type of higher growth rate, brings in more revenues, and ensures, long-term fiscal health. The other piece of it is the revenues. We have this additional tariff revenue, roughly 1% of GDP that's come in. That additional revenue helps to also helps with the fiscal situation. And then there's been a bunch of other reforms, some to entitlements that the CBO report actually tracks, which result in longer term cuts to federal spending. What's remarkable, by the way, is that we've experienced a fiscal contraction relative to last year, and despite that fiscal contraction, we continue to have a very strong economic growth. So part of what you can think about is that if you have supply side growth can actually get you to a situation where you simultaneously reduce the deficit, which is what happened last year. The deficit nominally reduced, and also as a share of GDP, and then while at the same time experiencing significant economic growth.
So a topic that actually I think was the very first one of this conference was housing affordability. And for that group, sort of top of the agenda was sort of deregulatory efforts. Making it easier for housing supply to be built out. So just curious about the administration's view on that and the sort of policy agenda or the path forward on that.
Yeah, I saw that in the survey materials what's true is that the amount of regulations when it comes to housing construction have really skyrocketed over the last 20 years and have made it essentially, extremely difficult to build. And there's heterogeneity in that. It does tend to be the case that the blue states have much more regulations, and that's borne out in the fact that, inflation rates are a little bit higher in blue states relative to red states. But that goes to the point that at the federal level, what the federal government can do in order to help deregulate is there's a certain set of tools that we can apply, and the federal government is doing what it can to provide lower regulations. Like there was the end of the AFFH mandate that HUD pursued, the opening up of federal lands. The Congress is considering different efforts here as well, where that can result in federal government deregulation. But I think at the end of the day, a lot of these decisions have to be done at the state and the local level. And what's true is that deregulating housing construction and supply can result in simultaneously, a healthy. It can result in jobs, and it can result with more homes for people to move into. So, in general, we are supportive of this effort, but a lot of it is at the state and the local level.
So on that point about jobs, there's actually a follow-up question from the audience, just essentially asking, in terms of increasing housing supply, any concerns about labor supply there, given the high concentration of immigrants?
At the moment, right now, when you look at construction, at housing construction, the absence of unskilled illegal immigrants isn't the bottleneck. The bottleneck is regulation. So that's a problem for another day. That's not the one we're facing right now.
Gotcha. So turning to an earlier thread, you had mentioned sort of the very strong GDP growth that we saw last year, but the relatively slower growth in the labor market in terms of employment growth. So what we have seen over the last few years is relatively strong productivity growth. Curious, what do you attribute that to?
Great question.
What are the sources of that? And then what are the prospects for this to sort of stay on its current growth path, or is there upside or downside risks?
Great question. In general, the productivity term that economists measure is always the one which we don't totally know, right? It's the je ne sais quoi of economic growth. But I think we've basically looked at this ourselves at CEA, and it's still preliminary, but it does look like if you do it at least across sectors, it does seem with some, it's preliminary, so we have to dig into the numbers a little bit. It does look like the sectors that are most capital intensive are the ones that are experiencing the more productivity growth. So that's the other thing is, of course, not not unexpectedly, sectors that are more AI intensive are experiencing more productivity growth. And also the sectors that are experiencing more deregulation are experiencing more productivity growth. But that's just a preliminary look at it. And, hopefully there'll be more research coming out from other places as well, trying to decompose this productivity growth and trying to figure out what's going on. But it has been remarkable. And, we anticipate that it'll be here to stay.
How much potential do you think AI has to further increase this in the future?
I don't have an exact number. We have a paper on our website that looks at the literature and the vast the gamut of numbers that people come up with, from the most pessimistic to the most optimistic. I think that there's a lot of hope for AI, and I think not. This is not what I'm going to say is not anything new, but at the end of the day, the biggest limits to it have to do with the hard limits to AI have to come from building out of data centers, electricity use, and so on. So it's actually the real economy, or at least it's always the real economy, but it's the capital goods and so on that are actually the bottleneck. And so I think part of the rollout and the speed at which it's rolled out, the speed at which it becomes more broad-based is ultimately going to be a question of how rapid the build-out can be, given the physical constraints. The physical world is actually, interestingly, a constraint on this. But some of the constraints of the physical world can always be surmounted by clever software solutions. That's sort of what happened during the previous period in the 1990s, where software solutions facilitated the flow of data. And so I'm hopeful that with some innovations that we can continue the rollout. But yeah.
So speaking of one of those constraints, there's a question from the audience asking about interaction between AI and resource availability, and asking about your views how that would impact demand for electricity, water, and I'll add in terms of electricity prices. Yeah,
no, great question. We certainly don't want to prevent the build out of the most incredible technology of our day, with government overregulation, but we want to make sure that it's happening in a way that's least disruptive. I don't want to get ahead of the president on the exact ideas and what we're going to be doing here, but the president is aware of this, and there's been lots of discussions in terms of trying to figure out how to make sure that all of this build out can happen without hurting local communities unduly. And there's ways to do it, because if the returns are truly there, and if the optimism is warranted, then the resources are available to do this in a way where companies can internalize the externalities that some of this build out entails.
So we just discussed productivity, and then sort of turning to some of the other key parts of long-term supply and long-term growth, thinking about labor supply and specifically demographics. So that's sort of a reality that was locked in many decades ago in terms of most of the of population growth in the United States. Just about sort of the administration's view about how the slower growing population moving forward, how it's going to affect long-term labor market trends, long-term economic growth, and what are some of the potential policy solutions there?
Yeah, it's a great question. I think ultimately the most important part is to make sure that we have a healthy labor market where if people want to work, they can get jobs, and if people want to work on their skills and they have the capacity to reskill and to keep working. In particular, if you look at the labor force participation rate among the older folks, you do see an uptick there. Some of that is compositional, but I think even within each age range, you see some increases there. So part of what we see happening over time, this is just purely observational, is that you see an increase in labor force participation among the older population. The one thing that you observe and actually Daron Acemoglu has written a paper about this, has some work on this, where in some of the societies where you've had more rapid aging, like in Korea and in Japan, you've seen more rapid adoption of robot technologies and automation. And so in a way, one of the ways to counteract the impact of some of these demographic shifts is to have greater utilization of AI technology. And so I would anticipate if I had to think about this issue, is that you can have aging, but then you can have solutions to ensure that if people want to work, that they can continue to work into their older age.
So taking a question from the audience here related to that, again, asking about the sort of federal debt outlook, but specifically asking about the Social Security Trust Fund. Any thoughts on there about how to forestall the impending insolvency of that?
I don't have any particular thoughts about that, and the president is aware of this, and he's very much concerned about. He's always been concerned about the fiscal outlook, and it's part of why he wanted to ensure that that we simultaneously increased revenues while reducing spending. And when it comes to the trust fund, I haven't had conversations with him about that.
Okay. So we discussed earlier sort of the ramifications of tariff policy and sort of what we're seeing there. But one question from the audience is asking about, it seems like the focus of trade policy has been on reshoring and shifting sort of manufacturing back to the United States. But over the past year, we've seen a loss of around 83,000 manufacturing jobs. So question asking sort of how do we view that in light of manufacturing?
Yeah, great question. So what you see is an increase in what you see is an increase in non-residential construction jobs. That's consistent with reshoring. What you see in terms of manufacturing value added is that you have a significant growth in manufacturing value added. You have significant growth in manufacturing productivity, and then you have significant growth in capital expenditure, as well as some of the capital goods imports, which I mentioned earlier. Eventually, as you have more and more of a build out, you would anticipate that can lead to more manufacturing jobs. As I mentioned, you see manufacturing wages rising faster than non-supervisory manufacturing wages rising faster than other jobs. That suggests that there's a lot of demand actually there for manufacturing workers. And so over time, we should anticipate probably some more manufacturing jobs. That being said, I'll just say a couple of things about that. Manufacturing jobs have been declining for quite a while, and actually the pace of decline diminished in 2025 relative to the previous 2 years. And if anything, what I mentioned earlier is if you look at the dispersion of job growth, like how similar is manufacturing job growth relative to other job growth, you see the dispersion in job growth that seems to be at historic lows. So that tells you that the right benchmark in an economy where the break-even rate is going to be lower because of no illegal immigration. The right benchmark isn't necessarily positive or negative. It's just if you want to look at a specific sector, you should compare that sector relative to all the other sectors. And from that perspective, I actually think it looks pretty good.
So what we are discussing the relative resilience of the U.S. consumer over the last year or so. And a question from the audience is asking about any concerns about consumer indebtedness, the potential that some of the resilience in spending might be due to sort of increased use of debt or even buy now, pay later. And it's sort of,
household balance sheets look really healthy. They're by historic, if you look at household debt to income ratios, it looks really good. So I'm not particularly concerned.
So we've touched on goods inflation, but another sort of thread that's emerged, at least in sort of the more macro focused sessions of this, has been when it comes to inflation, some of the stickiness when it comes to the service sector side. And curious about how you might square that with what we've seen from a relatively imbalanced labor market from your description, how we're still seeing relatively elevated inflation.
Yeah, I think so. Part of, that's a really good question. There's part of how that's borne out is in particular is when you compare the CPI to the PCE, and then there's certain parts of the PCE that look elevated, but then if you get rid of the market, if you look at market-based PCE and then and you strip out like financial services and some of the government programs, then it looks much lower. And so the way I would view it is we had a major inflation spike. And then as inflation returns back to normal, it's possible that, some of the things that we typically see, like a PCE, which is below CPI, we're not seeing it quite yet. But as we go back to something more normal, we'll see the PCE portion go back down. The portion of it that's related to rents is really because the rents are very backward looking, right? So if you look at how that's measured, it's just we're not looking at the new rents, we're looking at the entire history of rents. And if you have a major inflation spike and a lot of the landlords kept their rents where they were and they're sort of gradually catching up, that gradual catch-up process is going to manifest itself into a little bit more persistent rent inflation. What's true now is that if you look at new rents are growing at a historic low. So that tells you that the rent portion of inflation is going back down to, I mean, it is back down to historic levels, and it might even get to a lower place.
So since you're just diving into the details of economic statistics there, one question or sort of topic I want to raise is that there's been one session in particular, but overall, sort of over the last year or so, concerns about the sort of current state and future of federal economic statistics for a variety of reasons. So just curious about sort of your view on sort of how you think about and use that data, and what the path forward might be.
Well, we care enormously about having great and accurate data, and that's evidenced by the president's choice of Brett Matsumoto, who's a career BLS staffer who also works with me at the Council of Economic Advisors. So he's been nominated to be commissioner of the BLS precisely because we take this very seriously, and it's important to have someone of his caliber there. He really is a brilliant guy, Brett Matsumoto. In terms of the statistics more generally, I think that what's happened is and this is well known, over the last 10, 20 years, we see a decline in survey responses on a lot of these surveys. We see that. We also see an increase in the size of the revisions, particularly if you sort of take all of the revisions jointly, like add them up together, you see significant revisions, and that's evidenced by some of the more recently what we've seen in the labor market. And I'm sincerely hoping that we don't have to undergo the type of revisions that we've experienced the last couple of years there for total jobs. And so we're very much committed to making sure that we're collecting the best statistics and the most accurate statistics. And I think part of what will be happening once we have a new commissioner is I'm hoping that we have a look at that, and to make sure that we can do what we can to increase the response rates and to make sure that the data is as accurate as possible.
So how do you think about private sector data? So some more proprietary economic statistics, how do you integrate that into your view of the economy alongside the public sector ones?
Well, I mean, I look at all of them. So I appreciate all of the work that many of you do producing that data, and sometimes it's shared with us. I think that at the end of the day, the federal government's data will ultimately be the best because it's going to have the broadest scope, it's going to have the seasonal adjustments, and so on. But I think that the private sector data is very much appreciated. I like to look at when there's major discrepancies between the private sector data and the public sector data, just to get a better feel for what's going on. So yeah, I mean, I don't have anything else to say on that. But I think I'll tell you what, in the event of a shutdown like the shutdown that we had, which was the longest shutdown in history, we relied heavily on the private sector data to figure out what was going on. So it's very important to keep up that great work.
Was there a particular area or series that was particularly helpful?
The labor market data, yeah.
So one question, I'll sort of slightly reframe it, but sort of what's from your vantage point, from CE's vantage point, what are sort of the best tools or policies that we can, or sort of goals for the U.S. economy to help it increase its competitiveness, especially vis-a-vis China?
That's a great question. I think the most important thing is to use our strategic advantage, which is that we're not a centrally planned economy. We're a dynamic, buoyant economy where we have creative destruction, and we allow the marginal investment dollar to go to its best use, and that is our greatest advantage. And that's borne out in the fact that the economy's been doing well, that our stock market's been doing well. The other thing is that we really do thrive in terms of creating services that benefit from network externalities, like financial services or software services, and the current rollout of AI fits that. And I think that the fact that we are leaning so much into AI and dominating in AI is in part driven by the fact that we know that that's our strategic advantage. use of certain services where there are network externalities. So I think that, but overall, how does the federal government help? By getting out of the way, by making sure that the private sector doesn't face unnecessary impediments. And that's been evidenced by the rapid deregulatory effort that you've been seeing.
Gotcha. So returning to the theme of immigration, seeing a couple questions here, and I'll sort of lump them together here, is that how is the administration thinking about sort of higher skilled, higher wage immigration, and what would be sort of, how does that fit into the broader economic outlook and then also policy agenda?
Okay, so when it comes to, in terms of what's been done on high skilled immigration, what you've seen is a change in the H-1B policy, and by adding a fee for H-1B workers. And the way to think about that, because the H-1B visas are capped at 85,000, what a fee does is it ensures that that people who enter the lottery will be of sufficiently high value added in order to warrant the payment of such a fee. And so the way you can think about the impact of that kind of policy is that it deals with the fact that there has been significant abuses when it comes to the H-1B visa. So my former colleague George Borjas, who's now at Harvard but who was at CA with us for a year, has a recent NBER paper on this where he compares the wages of H-1Bs relative to the wages of Americans who would have the same job, seeing that it does seem like there's a difference there where the wages that the wages that are paid to H-1Bs are suppressed relative to the ones for American workers. And what we want to make sure of is that the system is not abused in a way where some of the lower value added workers are being brought in and displacing Americans, but the program is being used to ensure that we have the highest value added foreigners being brought in to benefit the economy. And that's actually net positive for a lot of our tech companies, because our tech companies are often finding it difficult to compete with some of the companies that are bringing in low wage workers who abuse the system. And so getting rid of those firms that are doing that is a net positive for productivity for the economy.
So have a question here, sort of looking at the recent set of, or last few months of data on consumer spending, personal income, have seen sort of a fall or declining savings rate. Just curious about how you interpret that in terms of the overall health of the U.S. economy.
I haven't thought much about the decline in the savings rate. I don't know if there's that much to it. I mean, a lot of the stuff gets revised over time, so I don't know.
Okay, yeah. Great. So I think we're wrapping up on time here. So I'll ask one question that we've asked a few of the panelists here. We have a variety of native scholars or younger folks, students in the audience. Just curious about what your advice would be to them for their career as economists.
So we have some young economists?
Yes.
They're PhD students?
I believe undergrads.
Undergrads. Oh, wow. Well, great. I didn't anticipate this question. Well, I think economics is a really exciting field because of the number of issues that you get to look at is quite vast. It's why we often irritate other social scientists. And the other thing that's amazing about economics is that you can have a very versatile career, as is evidenced by the folks here. You can work in the private sector, you can work in the public sector, you can work in academia. And I think maybe the one piece of advice that I would have is that when you get into the grind of grad school, taking the classes, writing the long problem sets and doing all that math, it might seem like this interminable torture will never end. But it does end, and I think when it ends, it can be very exciting. So I highly encourage young people to do this, but you got to go into it with open eyes because it can be a long journey. And actually, since I got my PhD 20 years ago, and I think that the field has just gotten so much more competitive since my day. So I wish our young folks interested in this the best of luck.